Thanks, Evan, and good morning, everyone. My name is Sydney Rubert, and I'm the head of PRT Business Development at MassMutual, currently based in Seattle, Washington. I've been at MassMutual for almost 4 years and have held a variety of roles on the PRT pricing team during that time. In my current role, I own the underwriting process and manage the PRT pipeline, as well as lead the implementation of new analytical and data management technologies. I'll now pass it off to Rob and Tyler.
Thanks, Sydney. So my name is Tyler Keenan. I'm a manager with the actuarial practice of Oliver Wyman. I'm based in our Boston office. My experience is primarily with the profit modeling software and specifically and most lately with pension risk transfer modeling. I've been with Oliver Wyman for almost 2 years at this point. And before Oliver Wyman, I spent 5 years at Unum, where I held a variety of roles, including individual disability pricing and modeling, enterprise risk management, and voluntary benefits.
Thanks, Tyler. And I'm Rob Forte, principal here at Oliver Wyman and office leader here in our Boston office. I work primarily on model conversions and specifically in mostly Axis conversions. Also a subject matter expert in statutory and GAAP regimes for annuities mostly. So we'll be your guides today. Next slide, Evan. Mm-hmm. So today we're gonna cover pension risk transfer 101. This is a very interesting and developing industry topic. PRT's really exploded in recent years. And has been turning out record numbers of volume each year recently. So today we're gonna kind of do a pension risk transfer overview, PRT 101, allow the group to gain familiarity with what PRT is, talk a little bit about structure of the deals, a little bit market landscape towards the end. And if this is well received and folks enjoy learning about PRT, then we'd love to do more sessions in the future where we can dive into more specific things like modeling and things of that nature. So I'll turn it over to Tyler for what is PRT.
Thank you, Rob. So like Rob said, I'll be covering what is PRT, and then we'll hand it over to Sydney, who can dive a bit more into the structure of our PRT deals that you might see. So what is PRT? Can we go to the next slide, please? So pension risk transfer is kind of a definition, is a negotiated transfer of defined benefit pension liabilities between a plan sponsor and an insurance company. And the key piece to note here is that these are defined benefit pension liabilities. So of the two main types of pension liabilities, you have defined benefit plans, you have defined contribution plans. Defined contribution plans might be something like your 401k or a 403b plan. And those are plans where you own the money that is in your account. And if the market does well, you do well. If the market doesn't do well, you don't do well. And so the risk of those assets is really yours as the consumer. In contrast, we define benefit pension plan, where I, as an employee, would be guaranteed, promised certain benefits by my employer, and the employer's ability to meet those liabilities is the employer's responsibility. I can be assured as a consumer that, or as an employee, that those benefits are mine and that I am entitled to them. And so the risk is on the plan sponsor or the employer in that situation. And so I'll talk a little bit more about this as the slides continue, but that's kind of the underlying purpose, really, of why these liabilities might be transferred. And so you can have multiple different types of participants in these plans. You have some participants who are already receiving benefits. We call those in-pays or in-payout or retirees, there's different terminology. And then you also have deferred participants or people who are not yet receiving benefits. And pension risk transfer transactions can kind of run the gambit in terms of what sorts of participants are eligible or are included in those transactions. And so if you look at kind of some of the exhibits down at the bottom here, you'll certainly recognize some of the Fortune 500 companies that have engaged in fairly large PRT transactions in recent years. Some of these are quite large. And the volume has been increasing, partially due to in recent months and years, just kind of pent up demand as a result of the pandemic. And some of it is just, perpetuating it's kind of a self-perpetuating regime where you start to see where companies are transferring liabilities, and that spurs other companies to do the same. And we'll talk a little bit more about that as well. All right, next slide, please. So I'll start with just maybe some of the mechanics of a pension plan here. And so when we think about a pension plan or defined benefit plan, it can really be thought of as similar to a payout annuity, if you're familiar with payout annuities. And if you're not, really the distinction there is that unlike something like a variable annuity or a fixed index annuity where you have some form of account, a payout annuity is really just a fixed benefit, or generally a fixed benefit that is paid to you over a period of time. And a pension, defined benefit pension, is often very similar to that. And so I'll talk a little bit about some of the specific nuances here. So like I said, we're referring to defined benefit plans here, where your benefit amount is often based on your length of employment with your particular employer, your salary history, and there's other factors as well, but that's how kind of the underpinning of the benefit. These are employer-sponsored plans generally, so unlike a traditional payout annuity where you pay a premium with an insurer, your employer is the one who is sponsoring this plan with you. And the mechanism for that is funding contributions. So throughout your tenure with a company, you are making contributions to a pension fund, your employer is making contributions as well, and that's the underpinning of where your eventual pension benefit comes from. And then finally, you have the different benefit forms that you're allowed to take. So when you do elect to begin receiving benefits, oftentimes you have some optionality around whether you want to receive a life annuity, which is just an annuity that will pay you until you die. You might have a joint annuity where benefits are contingent upon both you and a beneficiary, whether you're both alive, whether one of you is alive, something like that. It might be a annuity certain, where the benefits will just be paid regardless of whether you're alive or not. And if you were to die, then your estate or your beneficiary would receive those benefits. So there's multiple different options that annuitants are often allowed to choose from for their defined benefit pension plan. So these are just some of the kind of key terms and key pieces of a pension plan or a defined benefit pension plan that will then be transferred through a pension risk transfer transaction. So if we go to the next slide, please. So let's talk a little bit about the motivation for a PRT transaction. Why would a plan sponsor decide that it's important for them to transfer these liabilities to a third-party insurer? And we've called out three main reasons here. I'm sure there are others, but these are some of the main reasons why you might see plan sponsors engage in such a transaction. So the first one would be risk transfer, the second one is cost savings, and the third would be core business expertise. And we'll take each of these in turn. So the first one will be risk transfer. Go to the next slide, please. Thank you. So risk transfer, it's right in the title of the product, right? This is one of the primary motivations of a PRT transaction. So when we think about the risk, and I alluded to this a little bit before with regard to the defined benefit plans, the risk is borne by the employer. The risk is borne by the plan sponsor. And that risk can be longevity risk. It could be asset risk. There's any number of risks that could come into play with regard to a defined benefit transaction. Those risks are borne by the employer. And so what you're looking at here is a chart that shows in the dark blue line is the pension benefit obligation. So you can think of that as the liability or the reserve, depending on your background and the terminology there. And then the lighter blue line is the pension fund value. So that's the money that is actually backing the pension plan. That's the money that is available to pay out pension liabilities. And so going across the x-axis is time. Over time, what you see is your pension benefit obligation in the dark blue line is, kind of peaking at about year 7 or 8 there, and then it starts to run off. And your pension fund value, your assets, do something roughly similar. And up until maybe year 18 there, you have a surplus in your pension fund, right? You have more money on hand than you think you'll need to pay out future pension obligations. But after year 18, you see something changes. And now you're in a situation where your pension benefit obligation is higher than your fund value. And that can be for a number of reasons. It could be that people are living longer than you assumed when, at the start. It could be that your assets are not performing as well as you had hoped. And so their value is dropping. And so for whatever the reason, now you're in a situation once you get past year 18 where you have less money in your pension fund than you feel you'll need to meet your pension obligations. And like I said, defined benefit plans, that risk, that shortfall is owned by the plan sponsor. It's owned by the employer. So they have to figure this out either way. And so what can happen is a pension plan sponsor can transfer these liabilities, transfer this pension plan over to a third-party insurer at time zero, or really anywhere anywhere along the line. But if they were to transfer those liabilities between times 0 and 18, there's a chance that they might actually see some savings there, where they can release some funds that go back and hit their bottom line. Versus now when you're past year 18, if you were to transfer these liabilities, well, now presumably a third-party insurer is going to charge you more than you have in your pension fund, and you're going to have to come up with the difference. So transferring those liabilities really reduces that risk over time. And third-party insurers are generally well positioned to absorb this sort of adverse experience because oftentimes, as we know, insurers, this is what they deal with. This is what they do. They deal with long-term liabilities. This is their bread and butter. So as opposed to a plan sponsor that might be just a manufacturing company or a local municipality versus an insurer that's well used to dealing with this sort of thing. Next slide, please. So the second motivation is around cost savings. There are significant costs that can be saved through a pension risk transfer transaction. So like I said, oftentimes plan sponsors are not insurers. They might be manufacturers, they might be municipalities, they might be retail companies. The list is endless in terms of what sorts of companies might have these pension plans. And so in order to successfully administer them, they might have to be paying actuarial consulting fees to actuarial companies to do regular analysis on their block. They might be responsible for administering their plans or to paying a third party to administer those plans for them. And then there's also premiums that go to what's called the Pension Benefit Guaranty Corporation, or PBGC. And these are premiums that are paid by pension plans to what is essentially a guarantor of a federal agency that guarantees these pensions, so that in the event that the plan is underfunded, the employees have a backstop essentially. And so pension plans are responsible for paying into this fund over time. And you can see on the right that we have the chart of the premiums over time, that those premiums have only been going up over the past several years. And in some ways, that's somewhat of a self-fulfilling prophecy, in that the more companies that are participating, the lower the premiums will be. And as fewer companies are participating and they're transferring liabilities, those premiums will go up in order for that fund to stay solvent. Because the key piece here is that insurers are exempt from this. Insurers do not have to pay these premiums. And so there's some synergy there in terms of these cost savings that will not have to be borne by either the sponsor or by the insurer. Next slide, please. And then the final piece of this is just core business expertise. I've mentioned a couple of times the sorts of companies that might have these pension plans. They're not always going to be insurance companies. They're not always going to be companies that have expertise in long-term pension obligations or long-term liabilities at all. They might be, again, manufacturers. They might be retail. They might be hospitality. Who knows? And they have very specific core business expertise. They have very specific competencies that they are focusing on building day in and day out. And for every ounce of energy that a leader in one of these companies has to spend focusing on their pension plan and the way that pension plan manifests in their financial statements, that's time that they're not spending on their core business, their core competencies, and growing their business and their strategic placement in the market. And so oftentimes that's a pretty good motivation for why a company might choose to offload these liabilities. It's just not something they deal with. And again, in contrast, they send it off to an insurer. This is what they deal with day in and day out. Their insurance companies are experts at risk management. They're experts at long duration liabilities. And so that's often a pretty large motivation as well. And so with that, I will turn it over to Sydney to discuss the structure of a PRT deal.
Thanks, Tyler. I will now give an overview of how a PRT deal is structured. As a disclaimer, this is from the insurance company view, and there are additional steps prior to and post-close that will not be mentioned. Next slide. Pension plan transfer, or a pension risk transfer, is a business-to-business transaction where an intermediary sits between the plan sponsor and bidding insurance carriers. The plan participants, these are the employees of the organization, are not directly involved with the purchase of the annuities, but the outcome does have a major impact to them. All insurance companies attempt to make the transition from a current plan participant to an insurance carrier annuitant as seamless as possible. An overview of the main parties involved in a PRT transaction included the plan sponsor. As Tyler mentioned, this is typically the employer or a designated employee of the organization that sets up the retirement plan for the benefit of the organization's employees. The intermediary is a third-party consultant who prepares the request for proposal, or RFP, as well as coordinates bid day instructions and provides analysis back to the plan sponsor. All questions and legal reviews are funneled through the intermediaries. Additional third parties that can be involved in a PRT transaction include independent experts, independent fiduciaries, settlement advisors, and legal advisors. Insurance companies such as MassMutual receive the RFP and respond to the request. Depending on the opportunity, there can be anywhere from 2 to 10 insurance companies participating. Rob will provide an industry outlook later. Next slide. There are 2 broad types of PRT products in the market, a buy-in or buyout. The structural difference between the products is which party has the legal obligation of paying plan benefits post-close. In a buy-in, the plan sponsor transfers premium to the insurance company in exchange for covering future benefits of included participants. This is a revocable contract whereby the plan sponsor can unwind the contract within certain criteria. Unwinding the contract is not standard practice, and rather the buy-in is used as an intermediate step to a buyout in order to de-risk the plan while the plan sponsor has adequate funding, and then initiate a plan termination once appropriately prepared. Buy-ins have historically been a niche market. However, they are gaining in popularity. In 2021, there were 7 buy-ins completed out of 427 transactions in the market, making up about 10% of premium by volume. Insurance companies continue to enter the buy-in space, and it has been a hot topic for the last few years at industry events. On the other hand, buyouts can take the shape in one of 2 formats, and they provide for an irrevocable group annuity contract to the plan sponsor. Under the buyout structure, the insurance company becomes the administrator and takes on the legal responsibility for paying the plan participants directly. A lift out generally includes a subset of retirees, and a benefit threshold is used as a cutoff point for the participants to be included in a transaction. Examples, monthly benefits under $500. We also see many smaller deals such as under $100, and some plan participants have $1 or 50 cents as a monthly benefit, and you can see how those PBGC premiums are significantly higher than the amount that they're receiving. The employer continues to maintain and administer the plan for the remaining participants not covered in the lift out. Lift outs continue to be a popular option for plan sponsors looking to save on PBGC premiums and as an initial de-risking step. Lift outs can be initiated and executed in a relatively short timeline. 3 to 6 months is common. And in 2021, buyout premium accounted for about 2/3 of total market volume. A plan termination, on the other hand, includes all plan participants. This is both deferred and in-pay lives, regardless of benefit size. And post-close, the plan ceases to exist, releasing the employer from all risks and responsibilities of maintaining a pension plan. Plan terminations have a longer lead time and require IRS approval, generally taking place over 12 to 18 months. Next slide. The first step in a PRT transaction from the insurer perspective is receiving the RFP and completing a thorough review and an opportunity analysis. The RFP received will include a bid timeline, which outlines the preliminary and final bid dates, the first direct payment date. This is the date the insurer becomes responsible for making monthly benefits directly to the plan participants, and the mortality assumption date. Deaths occurring prior to this date would be excluded from the group annuity contract. Benefit specifications include the annuity forms offered by the plan, which can range in complexity, such as the life, joint and survivor, and certain life annuity forms that Tyler outlined are found in most plans, whereas others can include cash balance optionality, Social Security leveling, and grandfathered benefit formulas. Supplemental benefits such as flat dollar death benefits or Medicare premiums can also be included in a PRT transaction. Retirement optionality will also be described, such as early reductions and late increases available, as well as any disability provisions. Contract structure will be requested and various scenarios will be required, such as data group 1 under $1,000 and data group 2 under $500. A quote I've heard several times since joining PRT is, once you've seen one pension plan, you've seen one pension plan. While all pension plans have a common structure, there is an infinite number of modifications and optionality that a plan can provide. A thorough understanding of the bid request should be developed prior to submitting a positive intent. Data will also be shared during this phase. A census file is provided, which includes de-identified participant level data. This is checked for accuracy and any data gaps are noted. Mortality experience may be provided and is required for larger transactions. This provides plan level mortality experience and allows the insurer to more accurately reflect the mortality risk of a given group. An asset in kind or AIK listing may also be shared. This is the option to transfer the assets backing the plan obligations to the insurance company rather than paying in cash. This can, at times, result in a pricing benefit depending on the portfolio provided, since the insurer can hold the bonds transferred rather than source new assets with cash. Other pricing considerations include, is this a repeat client? Large plans have come to market multiple times at different benefit thresholds. And if you're the incumbent and provided a seamless transition in prior transactions, you'll likely be considered the preferred provider for future deals. Mortality profile. Insurers can be more competitive in certain industries. Current capacity from both a capital and resource perspective. We only have so many PRT pricing actuaries at MassMutual. The ability to quote on the request should be considered from both a pricing and operational perspective. Questions to ask include, can we model the requested bid provisions to generate an accurate premium for the risk? And can we effectively administer the benefit within our current payer framework? After providing a positive intent to bid, pricing work begins. Next slide. While this is a group annuity contract, the mortality assumption is determined at both the participant and contract holder level. Participant mortality factors can include gender, state or zip, benefit amount, and benefit type. Plan sponsor industry is also considered. Hospitals and financial services have a very different mortality profile compared to logging or manual. Continuous development for PRT pricing. Other actuarial assumptions can include retirement dates and optional form selection. Cost of living adjustments can also include caps, floors, and variable rates. Market inputs for a PRT deal include asset allocation, interest rates, and spreads. Each insurer will also have internal pricing metrics that must be met. On the preliminary bid date, all of these inputs are combined to generate a bid, and it, along with a proposal, is provided to the intermediary from all participating insurers. Next slide. 2 to 4 weeks after the preliminary bid, the final bid date will be set. Between the prelim and the final, the insurer will refine assumptions, request feedback from the intermediary, such as the number of insurers participating, the average bid, and the spread of bids. We'll also monitor market conditions and attend any client meetings as scheduled. On the final bid date, day of pricing takes place. This includes setting final pricing targets and updating market conditions, as this is a spot price product. The most competitive bid is provided. The final bid and proposal are usually due between 10 and 11 a.m. Eastern. And yes, on the West Coast, that means some extra early mornings. Quotes expire on the same day and selection occurs by mid-afternoon. The Employee Retirement Income Security Act, or ERISA for short, has established a guiding document for the plan fiduciary to use in selecting an annuity provider, commonly referred to as the 95-1. Some of the criteria that should be considered in selecting an insurer is the quality and diversification of the annuity provider's investment portfolio, the size of the insurer relative to the proposed contract, and the level of insurer capital and surplus. It is worth noting that after conducting an appropriate search, more than one annuity provider may be able to qualify as the safest available. And assuming all insurers meet the criteria, premium can be a deciding factor, with the lowest price chosen. Next slide. Although the pricing team's work may be done on the final bid day, there is a large operational lift to transition the participants and execute a group annuity contract. Installation generally takes place over 3 to 6 months with the major milestones shown below. A few quick comments. The premium is received up to a week after the final bid date and not transferred on the day of the final bid. The annuitants covered by the group annuity contract are notified just prior to the first payment date when our call center and web portal are ready for an influx of activity. The pricing actuary is involved near the end for a quick premium true-up, and the group annuity contract is signed at the very end of the process. I will now pass it off to Rob to give an overview of the PRT competitor landscape.
Awesome, thank you, Sydney. So for market landscape, we'll touch on a few of the the major things going on. Strategically, we're involved with some of the market entry activity and pricing support activity, as well as folks looking to use reinsurance and folks looking doing modeling, PRT modeling, model build, stuff like that. And through those experiences, we've gleaned quite a bit of data on the market landscape. And so go ahead to the next slide, Evan. Mm-hmm. So, first we'll provide some industry perspective of what we're seeing in the market and what we're hearing from many of the market participants. I think as both Sydney and Tyler touched on, there's been a lot of activity in the market over the past year. Tyler mentioned specifically all that pent-up demand due to the pandemic. In addition, we've had some strong equity markets, although this is something that it has turned very quickly in recent weeks. But during those strong equity market performance of late, that does have a positive impact on the PBOs, the funding levels for the pension plans, and puts them in a little bit more of an attractive position should a plan sponsor be looking to offload. We also have seen the rising interest rates, which particularly in the second half of last year, and that's going to allow insurance companies that are competing in this space to get a little bit more attractive asset yields, and really that's going to put some downward pressure on bid prices. And of course, again, if you've got higher funding levels or more attractive bid prices, those are both very good incentives for plan sponsors looking to offload these deals at an opportune time. That being said, there's been quite a bit of turmoil in the financial markets as of late, as well as inflation ticking up considerably. But we're not really seeing a whole lot a whole lot of change in the industry in terms of how much volume is happening. The Q1 2022 PRT volume being the highest Q1 volume in history just continues this positive trend. We're also aware of and working directly with several insurance companies who are trying to enter the US PRT space for the first time. Some of these are companies that are active in other PRT spaces around the world, but haven't gotten a foothold in the US yet. And others are newly looking to get into the US market. So certainly there's a lot of appetite on the insurance carrier side to kind of to gobble up all of this pension risk transfer liabilities that are hitting the market. And there's a lot of reasons why plan sponsors are looking to offload these things. Another trend that we're seeing, so deferred lives have been touched on a little bit today. The idea of in-pays versus deferreds for pension risk transfer, what that really boils down to is, when you look at a pension plan, any individual, they're either retired and currently receiving benefits, which essentially means they're just like a payout annuity, basically, or they have not retired yet. And so there's a lot of unknowns to those folks. When will they retire, and what plan form option will they take? Are they going to retire next year? Are they going to retire in 10 years? Are they going to take a simple period certain annuity? Are they going to take something a little bit more complicated? And the terms of these pensions don't necessarily mean, from an actuarial perspective, that all of those choices are actuarially equivalent. And so as a result, deferred lives brings on a lot of risk, a lot more risk than the in-pays. And this is a place where many of the market participants have, as you'll see in the next slide, have avoided. But we're seeing a lot more experience, carriers gaining experience with those types of plans, and therefore more appetite and more competition for deferred lives in this space. We're also seeing a lot of big deals. I think there's been like 2 so far this year that were north of $1 billion, which is already, which is a pretty big number. And then, Sydney touched on the topic of the buy-ins a little bit, and this is a very interesting development. Essentially, the buy-ins are being used as a conduit to convert to buyouts. So in other words, companies are bringing these, plan sponsors are bringing their pensions to market, and they're okay with doing a buy-in at first, which for us actuaries, you can just think of that as almost like reinsurance in a way, just to transfer the liability and get it off the books. And then it takes a little bit longer, and it's quite a bit more involved to do a buyout. But once the buy-in's locked in, they can then flip it over to a buyout, which is a full transfer of the liability. You can almost think of it almost like a novation in our actuarial terms when we're thinking about life reinsurance. So we're seeing this strategy get used more and more often, and is really picking up traction in the market. And so those are current trends. In terms of the opportunities and the outlook, I touched on a little bit, but we're definitely, there's just a lot of volume going on in this space, and it's just increasing, and there's a lot of competition. And so companies are looking for insurance companies are looking for any edges that they can find. Folks are really leaning on ALM. I spoke to a client just this past week who they're one of the folks that, they're very busy in other spaces like fixed index annuities, and their ALM is one of their strengths. But PRT is a little bit of a different bear, and they were coming asking, for strategy advice on ALM to enhance their PRT book of business and their competitiveness on the new business. So people are really looking to squeeze out every little bit of juice that they can find here to maintain competitiveness, as well as benefit from the earnings that they could potentially make on the in-force blocks of business. We're also seeing a lot more usage of offshore reinsurance to some folks. In particular, one company that we're helping with market entry right now, they were basically saying, we basically think we need offshore reinsurance in order to be competitive. Now, there are a few folks out there that aren't using it, although I think many are. And we've been approached by several companies looking to expand into this. But this is the first that I heard of a company basically saying, we feel like we have to do offshore reinsurance just to be competitive here. So that's an interesting trend, and we'll talk about that in a little bit later. Mortality underwriting sophistication, this can in any market really in our profession. I mean, this can create an edge if you're very good at it. And so some folks are looking to specialize there and use that as their competitive advantage. If they feel their underwriting sophistication is better than others, then that might help them to identify bad deals and stay away from them, as well as find good deals and end up having the best bid price, but yet realizing unbeknownst to others that there might be a lot more value in that plan. And then of course, as we're always seeing in all lines of business, just trying to get more fluid with expense management in order to maintain competitiveness. And this is a place where, recent hikes in inflation and companies' views on inflation and how that's going to pan out in the coming years, that kind of influence how they're looking at expenses here. So moving down to kind of the competitiveness and being more flexible with plan demographics. Really what we're getting at here is when there's a lot more competition in the marketplace, a lot more insurers that folks are having to compete with. Really what that boils down to is it becomes a little bit more of a seller's market. And so companies need to be flexible. You're seeing that a little bit on the deferred lives, but you're also seeing that in some of the other places as well. Just go to the next slide. So, here's an overview of key players in the U.S. market. I took a quick look at this before the session today, and I think of the participants that are typically at the Actuaries Club Boston meetings, maybe MassMutual is the only one on here, unless maybe one or two New York Life people. So, there's a lot more companies that are maybe not here in the Boston area that are very active in this space. We also know that Sun Life being in the area, they're very active in the Canadian space, although not in the U.S. And what we've tried to lay out here on this slide is to give folks an idea of different insurance companies are active in different areas of this space. So there's, on the left side, you see the case sizes, going from small to large and jumbo. And then across the top, looking at deferred and retired participants versus retirees only. Some companies are, primarily only comfortable right now in retiree only business. The deferreds, that optionality, that brings risk, that also brings even more modeling complexity, which is pricing complexity, which that alone, and the uncertainty around that, and the difficulty of isolating what that could potentially be in terms of a risk or a value, does keep some folks away from those deferred deals. Right next to kind of that dividing line, you do see some companies, this is a little bit imprecise, just trying to fit everybody on here, but at least one of the 5 companies adjacent to that line, we know are involved in a little bit of deferred action, but primarily if that's a very small portion of a much bigger retiree block, but aren't super comfortable yet doing a lot more of the deferred deals. And as we move to the left, you start to see some of the bigger players. And then of course, as you move down, you see also the players that have more appetite with the larger deals. Now, Cindy touched on one very important piece of the pricing and the opportunity here, which is capital. One of the big limiting factors for companies, particularly going after the larger deals or trying to do more volume, is their access to capital or their ability to free up capital. We do hear this a lot when talking to high-level executives, even CEOs of some of these companies, about what their strategies are and what they'd like to do in the PRT space. And 2 weeks ago, I did speak with somebody that's sort of on the top rung in the smaller case size area here, and he basically said, we want to do bigger deals, we want to do a lot more business, we want to get even down to large and jumbo space, but we need to find strategies internally, whether it's offshoring or otherwise freeing up capital in order to go after those deals. So that can definitely be a limiting factor for the growth of companies in this space. So business models, this kind of goes hand in hand with the prior slide, so not going to spend too much time here, but the general idea here is that there are different ways to attack the market, and it's unlikely that any given insurer only fits into one of these buckets. Potentially they might play in 2 or 3 of these or more, but just to give folks an idea of what some of the types of players may be. There are some folks that only go after these micro deals, the very small ones. We've been helping a company with a model conversion, and they've got like almost 200 deals that they've done, and then we're working with another company that we're doing a conversion, and they've only done I think 8 or 9 deals, and the 2 companies are not too far off in terms of the number of billions of dollars of PRT business that they have on the books. And that's because one of those companies is more comfortable going after bigger deals, and the other one is very much looking in the small to micro space. What can be very interesting is towards the bottom, the jumbo and the syndicate section. So jumbo, very capital intensive, potentially like high risk in the sense that if you misprice it, I mean, it's a jumbo deal, there's a lot of money at stake here. And so there's fewer players that can really go after some of those deals. Syndicate, what we're getting at there is sometimes in order to be competitive in that space, other folks that might not be able to get in on their own can potentially build or participate in a syndicate to be competitive in that space. Go ahead. Market entry. So this is something that we get asked about a lot. It's definitely companies are really trying to get into this space, into the US PRT space. In particular, there's just a lot of potential out there. The sheer amount of pension liabilities that have not been transferred to this point leads to a very, very big potential amount of business that could be done. And so, when it comes to market entry, there are a lot of things that companies are look to consider, look to square away before they can get into the market. And you can see immediately here, as we go left to right, there's a legend at the bottom that talks about that is indicating the importance of having that capability in order to be competitive in that market. So for small, large, and jumbo, you can see, to be competitive in the smaller space, there's potentially a lot less that you need to do or do really well in order to get a foothold. But if you really want to be more competitive in the large and jumbo space, you have to sharpen the pencil in quite a few different areas in order to get there. And so, at a high level here, and due to time, I won't get too deep into it, but some of the places that are very important, obviously the ability to just price, but with investments, Sydney talked a little bit about in-kind assets and being able to receive those. There's also just investment strategy, ALM, and yields, and making sure that you have, you're able to source some good assets and then construct a strategy that allows you to get the kind of returns you need to be competitive without kind of garnering too much capital requirements that almost prices you out there. Talking briefly on underwriting and pricing, there's the assumption setting. And if you're not going after deferred lives, this can be on the simpler side. If you're not looking to do offshore reinsurance, this can be on the simpler side because you're really just dealing with mortality and a little bit more predictability. But to the extent that you're getting into the deferred space or the reinsurance, those do add quite a bit of complexity for market entry capabilities. And then the last bit is just sort of operationally. There's really 2 ways to admin. You can either outsource it or do it in-house. and doing it in-house can be very difficult if you have deferred lives as well. There's a lot of complexity there, but outsourcing would mean insurance company going out to one of the industry vendors. Alight is one of them, and basically having a third party administer your PRT business. Next slide. And then lastly, we have kind of a little bit more on the offshore reinsurance. So, keeping it high level, and this is something we could definitely go into in more detail on PRT and other lines of business in a future session if folks would find that interesting. Offshore reinsurance is hugely picking up steam in the industry, and particularly seeing a lot of companies setting up sidecars. And that's been used for all sorts of different types of business, and PRT is definitely becoming a very big one. We see the usage of the offshore reinsurance, as I mentioned, in some cases, some folks feeling it is a requirement to be competitive with pricing and making bids. But we're also seeing that companies that haven't engaged in this activity yet, that are looking into it for the pricing benefit, also potentially can see huge profitability boost on their in-force blocks as well, if they're considering offshore reinsurance. The benefits come in a few flavors. Asset synergy, really think of it as both sides of the balance sheet plus tax. On the asset side, the offshoring allows you, folks will ship this business over to an affiliate in Bermuda, and that will allow them to gain access to much higher yielding assets that have whether it's private equities or other assets that they can tag to their PRT blocks and earn quite a bit more on. Then on the liability side, the regulations, the asset requirements are a little bit more favorable to those strategies in potentially in a place like Bermuda than it is in the US. And so putting those two together, that's the majority of the benefit. There are sometimes tax efficiencies, although those are a little bit harder to squeeze out and smaller in their benefit these days than they used to be. In closing here, the PRT space, it is very hot. It's something, just the acronym PRT is something that I remember hearing a number of years ago, more and more, and not knowing a whole lot about it and wondering what it was. But now it has really just exploded. And so we wanted to do this one-on-one session for the ACB here to give everybody a nice overview of what PRT is and how a deal happens, particularly from an insurance company's point of view, and then what we see in the industry of late and what we see coming down the chute. Again, if you go to the next slide. And again, we're definitely interested in doing more of these sessions if folks find them interesting. PRT is something that Tyler and I work on a ton, and it is in Sydney's job title, right? So something that's near and dear to our hearts, and we're happy to speak to more. So please feel free to reach out to any of us with follow-up questions if you haven't already asked questions, which we have about 10 minutes to answer here. But feel free, either if you don't feel comfortable, or if you'd like to, if you forget, or if you'd like to do it at a different time, to reach out to us with any more questions you might have. And also feel free to propose topics in the future, like I'd like to hear more about, actual modeling of PRT or something like that. And we'd be more than happy to do that as a follow-up. So with that, we'll turn it over to questions.
I'm gonna just pull this up.
So Evan is helping. He's been monitoring the questions for us here. Okay.
Actually,
Oh, we have one.
yeah.
So we have one in the chat. So this is from Mike Presley. How are deferred lives treated later if those receiving payments are transferred. So, do you want to
actually, I was gonna maybe see if Sydney, if you wanted to take that one.
Sure. So I'm trying to read into the question maybe a little bit, but deferred lives, if they are transferred, they would not be receiving payment. And so they would go into pay status when they reach their normal retirement date, or if they decide to start early or late, they would obviously have actuarial adjustments applied to that. That generally speaking, they would not be included in a lift out transaction, and they would be part of a plan termination, especially if they were actively working at the company at the time. A defined benefit plan does need to be frozen in order to be terminated, and it would also need to have all of their actives and term vested participants vested in the plan. So I guess that's a little bit more information on deferred lives, but happy to follow up if you have additional questions.
Right, and if the question was more how are the in-pays handled on a transfer where maybe they're getting payments from the insurance from their plan spot, basically their former employer, and then the insurance company takes it over and they need to start sending them checks instead. At that first payment date, there's a welcome kit that comes out ahead of that, and actually Sydney, you probably know a little bit more about that. And then, eventually they'll start getting checks from a different source. But Sydney, do you want to cover that bit a little bit more?
Sure. So shortly prior to the first payment date, we do send out a welcome kit and provide information to the participants about what benefit they're receiving and how they'll receive it. They continue to receive the benefit in their previously provided method. So if they were an EFT or bank deposit participant, then they would continue to receive that amount monthly in the same format. And if they've been receiving checks, they would also receive checks at that time. So there's really no difference from the annuitant perspective, or at least all insurers attempt to make that as seamless as possible, and so that the annuitant doesn't experience any gaps or delays or changes. We are dealing with an older population, and so we want to make sure that we are as consistent with their prior payer going forward.
Yeah, so the next question came up when Rob was talking a little bit about the opportunities and outlook for insurers in the PRT market, and he mentioned mortality underwriting sophistication. And so what are some ways that insurers are refining their underwriting of mortality risk?
Do you want to jump to that slide actually?
Yeah.
So for mortality underwriting sophistication, I think certainly, Sydney mentioned earlier that different types of populations or different types of industries are certainly going to have different types of mortality. And to the extent that, so some of these carriers work with like third parties that have sophistication in this area as well. But essentially what folks are trying to do is really nail down try to nail down with a little bit more certainty what the difference is that in mortality rates that this population or this type of company or industry might experience relative to others. There's more broadly, there's sort of the white collar, blue collar distinction, but within there, let's say white collar, looking at different types of folks, whether it be, I think Sydney mentioned like lobbying or investment, people who work in investments and things like that. You might see a little bit different trend. What you're really trying to get at in terms of that sophistication, I think, is if you're able to identify, compared to not layering that on, what deal might be more attractive or less attractive. So let's say that your sophistication is leading you to believe that even though this is a white collar deal, it's an industry segment where maybe the mortality might not be quite as favorable. Then that would allow you might say, okay, well, given that we're a little bit more sophisticated than others in this space, the deal price that we would eventually bid on might not be as competitive. So maybe we'll stay away from this one. And if it might be in a different area with the opposite effect, then you might say, okay, well, we're willing to really go after this and really try to win it because we believe there's a competitive advantage that others might not see. In terms of more specifics there, I can take it back internally and give you some more concrete examples if you'd like to hear that. For whoever asked that question, just please feel free to reach out to us and we can do that. Sydney, do you have anything to add on that one?
I would just add that all insurers continue to evaluate different factors. So I had mentioned, gender, benefit amount, and state and zip. So zip plus 4 is becoming, a new industry analysis tool. And we continue to look for other areas that we could model off of as we look to use predictive analytics and data analytics for pricing purposes.
Yeah, so this question came up when we were talking a little bit about the big players in the PRT market. And so this individual noticed that many mutual companies are in this space. Is there a reason that more mutual companies are in the space as compared to public companies?
Sure, I'll take that one. As a mutual company at MassMutual, we strive for the long-term view, and we think that we have a competitive advantage without the need to provide shareholder updates quarterly, and can strive for that long-term perspective and provide value for our plan participants, who are really the owner of the company, our policyholders, rather than shareholders. And so this also feeds into the mindset for our annuitants, and we can take that long-term view while the market may be down or volatility within the market. We have the ability to weather that storm and provide a stable outlook for the long term. MassMutual.
A well-deserved plug. And we also work with several private equities pretty closely, and they're often looking at or their subsidiaries or companies that they've acquired are often looking at these deals as well. And it's a similar idea, long-term view, and in particular, these private equities tend to have, they're really the ones using offshoring and having access to alternative assets that are potentially very favorable, and they're looking for assets and of course the liabilities to match it in order to buy more of that stuff and take advantage of it. And so then, to Sydney's point, a publicly traded company that takes by definition a little bit more of a short-term view might not always look at it the same way, although there are some publicly traded companies on here that are very busy in this area as well. Can you do one more?
Yeah.
We have time for one more.
All right, one more question. So when a pension plan is transferred to an insurer, it takes on the form of a group annuity. So what are some of the key differences between a group annuity and an individual annuity?
Good question. I don't think I have. I'll defer that one to somebody.
Well, there's one that I know of is the statutory valuation is a little bit different between the two, but that's probably not the point of the question. Other than kind of the plan format, essentially, if you're thinking about the cash flows or the liability itself, we see very similar things in both spaces. The same flavors of period certains and joint survivors or single life annuities or certain and life. There is not a whole lot of differences there, but the differences is more distribution, like how they came to be, and potentially the group of folks that are all put together in this. So like an individual that goes out and buys an annuity is going to be a little bit different than this whole group of everybody who are working at this one company. Sydney, do you have anything to add on that one?
Sure, just quickly, I would say that there's not too much different in terms of the cash flows and kind of the back end stuff. But yeah, from a distribution perspective, a group annuity contract participant is not the contract holder. They do receive a certificate from the insurance company, and we provide them the information to collect and make a benefit claim. Whereas an individual annuitant who brings an amount or funds an annuity, they are the contract holder, and they have the ability to make a lot of the decisions regarding their annuity purchase. versus the group annuity contract participant doesn't have those same optionality. You know, they're locked in with their plan sponsor and can't deviate from that to a major extent.
All right. Well, thank you everybody for joining us today. And we're sorry we didn't have a chance to get to all of the questions, but like we said, you know, feel free to reach out to any of us. Our contact information is in the deck. I believe it's going to be posted either online or somewhere later on. So feel free to reach out to us if you have any questions that come up, or if there was any questions we didn't get a chance to answer yet today. So thank you again for joining us, and have a good rest of your day. Hope to be able to meet some of you in person this afternoon at the networking event. Have a good rest of your afternoon.
Thank you.
Thank you, everybody.